So today I'm going to talk about how to track inventory and COGS using the weighted average method. Um, and the reason this is important is because your COGS is the basis for your pricing, your overall profitability, and your cash flow, right? It's the number one decision you make, or the number one piece of info you need when sourcing new products, and it's the basis of your unit economics. So it's really important that we track the proper profit properly. What I'm seeing with a lot of brand owners is they're not using a consistent method for tracking this. They might be using the last price, or they might have their own methodology of tracking it, which isn't consistent, maybe some sort of average, or they might just be making an estimate off the top of their head, right? But this isn't the proper way of doing it. If you're looking to get a bank loan, or you're going through some sort of financial audit or due diligence, I promise you that the person on the other end is going to look into how you're actually tracking that number, because it heavily influences your profitability, and a few percentage points in either direction could really skew your valuation or skew your profitability. And you could, overall just be over or underpaying in taxes and you don't even know it, right? So let me get right into it. So there's 3 inventory valuation methods. There's FIFO, LIFO, and weighted average. So first in, first out means that we are expensing the oldest inventory first, right? So what that means is, if we, in this example here, if we ordered 3 batches in April, May, and June, right? Okay, and we sold 1,000 units. That means our cost of goods for say July, say we're tracking this in July, is $5,000, right? We sold 1,000 units at $5 landed. It's our cost of goods for that month is 5,000. So that's first in, first out. You're basically expensing all the oldest inventory first. The other method is last in, first out, which means that if we had 3,000 units on hand, we would be expensing the most recent inventory. So you can see in this example here, and this is just a simplistic overview, the landed cost is $7, right? Costs tend to increase over time, right? This is normal. So in this example, your cost of goods is $7,000. So here you can see how your profitability can change just off using a different methodology. As far as I know, last in, first out is actually not, you're not able to use that in the U.S. So, but this is one of the examples, one of the inventory valuation methods. And then the last one is the weighted average method, where you're essentially taking a weighted average of all of your inventory, and the way you calculate it is you take beginning inventory cost plus purchased unit cost and divide that by the total units available. So let me kind of get into how this actually works and how the spreadsheet works. So in this tab here, we have the purchase log. So in this tab, like it's really important to actually make sure that you're keeping a log of all your purchases, right? So I understand that you guys might order a container and have 3 different SKUs in one container. So in that case, you might want to divvy up units, but I'm going to keep the example simple here. So say we have SKU number ABC-001, and again, keep your SKU numbers consistent. Have like a consistent methodology for naming your SKUs, because this is going to help in kind of tracking those costs. And say for that SKU, we ordered our first container in May at $7.50 a unit. We ordered 1,500 units. Shipping and duties was $22.50, so our landed cost was $13,500. So our landed was $9, right? We basically took the landed cost divided by number of units. You also want to track your deposits, right? The deposit date, the balance due date. This is important to give your accountant. For me personally, I love it when, well, to be honest, no one really does this, but I've probably encountered one person that actually does this. But when you're highly detailed, this really helps your accounting. And I would always err on being extremely detailed when it comes to your accounting. But anyways, your landed cost per unit comes out to $9, right? The second batch you order, it's still the same unit cost, but your shipping and duties went down, right? So your landed cost per unit came down to $8.81. So in this example here, a brand owner might tell me, "Hey, Daryl, my costs were $8.81," right? Because they're thinking the most recent number in their head, but it's actually the average, right? So all in this schedule, all you would need to do is just update this, and that would feed into here. So I know at the beginning we had 15 units, right? And our beginning inventory cost is 13,500, right? So on my balance sheet, I should be showing 13,500 of inventory available at the start of the month or at the end of the prior month. So if I purchased 1,000 units at this cost, my units available now is 1,500 plus 1,000 is 2,500. The total cost is 22,300. So my weighted average is $8.93, right? So now I have the COGS. I give this to my bookkeeper or accountant. Then all you would need to do is plug in. You need to pull your Amazon, your Shopify report, anything that you sold wholesale, retail, etc. You might track retail a bit differently though, or wholesale, I should say. But then from there, you would just take your weighted average times units sold, and that would be your COGS, right? So this is the number that would go on my P&L if I was right in this example, if I was running a single product store and I was starting as a seller, right, or a brand owner, if my pricing is 25 times 750, so my revenue for that SKU is 18,750 at a price of $20 per unit. So my revenue would be this, and then my COGS would be this number, right? So then this would be my gross margin. And then you would subtract platform fees, et cetera, et cetera. And then you would do this every month, right? You would do this every month, and then just start the whole cycle over again. So this is like an easy way to really just go ahead and track that. One, your inventory number is accurate on your balance sheet, because this is super important. And then two, your cost of goods on your P&L is accurate, right? And let me just kind of go back to this, right? Because if your cost of goods is overstated, then you're understating your profitability, right? So like going back to this, if instead it was 6,600 but it was 8,500, if you overstate it but 8,500, then your profitability is going to go down, right? So that not only affects your valuation, if you were to sell, but if you're looking to get a bank loan, get some funding for your business so you could grow, that's not going to look favorable to lenders. And then on top of that, if you were to get audited, say you underreported income on your taxes, that wouldn't look good as well, right? So, of course, you want to report the number that is most accurate and most indicative of how your business is doing, right? The last thing is that it affects your cash flow, right? If you're thinking that you're making $5 a unit, but you're only making $3, that's going to impact your cash flow. You're going to look at your numbers and be like, well, why is my cash so low? So you always need to tie back to, you should easily be able to see and understand why your cash isn't the way it is, right? Um, I know for a lot of brand owners, cash flow is probably the number one issue because you're spending and reinvesting so much in inventory. So just making sure that number is accurate, that your gross margins are equal to your cash flow, or are in line with your cash flow. It's important to run in a healthy business and making sure that you continue to grow. So yeah, so that's about it. If you want the link to the spreadsheet, I'm going to include it in the description. And if you're interested in learning more if you have any questions, first of all, just feel free to email me, or if you're interested in getting help with your books and getting your financials done, feel free to schedule a call and we can chat. All right, have a good one.